Welcome, my name is Simon van den Heuvel and this is the fund structuring webinar about how to set up your own investment fund. Today we will be having a few guests, under who is Rowan Rosemond. He's going to talk all about the structure of an investment fund. We have Kelsey Bastiaan, she's going to speak about operational challenges in an investment fund. Then we have Dirk van Dam and he's going to speak more on what legal considerations we actually have to take when we set up our own investment funds. And lastly but not least is Jester Schilder, who's going to speak about the communication challenges on how to actually communicate your funds to potential investors. And we're going to dive right into it. First, I have Rowan Rosemond, that's the first guest, and he's very well versed in the structure of investment funds, what kind of vehicles you can set up to get the most optimal results possible. So, Rowan, thank you for joining us.
Thank you, Simon.
Let's dive right into it.
Yeah, first sheet, I wanted to talk about why you could set up an investment fund, and that's of course down to getting yield with investors. Right. You pool the resources of investors, capital, to buy a certain asset that you think will yield well. We have a whole bunch of assets here together, which can be bundled into funds. We've done a lot of them, like common stocks or real estate, sovereign bonds, foreign exchange, art, everything you can definitely think of that can yield. You can put into a fund and collectively invest in with investors.
Right, so it's basically putting a lot of investors' money, combining together and put it in, let's say, an asset that will bring the most returns.
Yeah, right. That's the basic concept of it. And to give you an understanding of funds that are out there, there are funds of funds, there are income funds, there are hedge funds, there are crypto funds, there are real estate funds. Well, on the screen you can see a whole list of different funds, but it all comes down to the same thing. A fund is the same in all these different names of funds. Simply the strategy itself is different, and therefore there's another name to the same vehicle, so to say.
Right. I think we can dive into it a little bit more on the next slide.
Yeah. So if you want to set up a fund, you really need to know indeed why you're going to set up that fund. You need to know, like, what kind of assets are you going to invest in, and what kind of investment you need from your investors, right? But also how you will create the yield, how you're going to structure the deal, are all very important things you need to know upfront before you start a fund. And therefore you can set up the fund with the end goal in mind, so to say. And the end goal can either be a specific end goal where you're going to reach together a certain goal, but it can also be that it will be ongoing. So, for example, a fund in the stock exchange will keep going for ages.
And maybe you can name an example, because I can imagine starting a fund might be intimidating, specifically because there are so many different types of funds you can set up. So could you maybe give an example of a situation where somebody will start their first fund? Because I can imagine that in the first case they are, for example, already trading in, let's say, Forex, but they do it individually with their own money. So what is the reason to actually set up a fund in that perspective?
Well, in that example, if they're trading Forex, for example, they could set up a fund to pool capital in from other investors. Right. But another example would be that you're a real estate agent, and you're looking to join the deals of the real estate. So you pull capital from investors instead of actually outright selling the property, pooling them and joining in the return, but then also, of course, doing the execution of the fund, so buying the property, renting it out, or developing the property itself in the fund, and then sharing the profits down to their individual part.
So it's very much about the scalability, basically, of an investment.
You're definitely scaling your funding, so to say, and it depends on the asset and how you would structure it. And we could go into a little bit deeper into that in maybe the next sheet, where we have the structure of a fund. This is a simplified structure, but I first wanted to start here to give you a better idea of the parties involved, so to say. Right. So the LP, the limited partners, are the investors themselves, and the LP, limited partner, already says what they are. They're limited in their ability to perform any task in the fund. And the general partner, which is usually the one that sets up the fund, is the one that executes on the strategy that has been presented or is at offer. And together with the LP's money and the GP's performance, so to say, they will create the yield. And that can be in different projects, can be different asset classes, just on how you want to structure it. And then there is, most of the time, there is a custodian who would take care of the pool of capital, so to say, so that there is a clear divide between the general partner, who's actually running it, and the money that is collected in the pool of limited partner investors, giving extra security to the limited partner that the capital they invest is actually only used for the purpose that you are collectively agreed on.
Right, so if the people look at the screen, they will see the fund and they will see limited partner and GP custodian. The GP is basically responsible for the strategy around the project. So let's say if it's a venture capital firm, you will see different types of startups perhaps they invested in, where the GP is managing these investments and perhaps giving some advice to these projects. And the custodian is only responsible for the pool of money that's actually inside the fund and managing that for the GP and the limited partners.
Yeah, a custodian can be a bank also sometimes, especially bigger funds is usually a bank, which makes sure that the capital is only used for a certain purpose. But it can be also a non-profit vehicle which manages that responsibility. It all comes down to the fact that you need to have a clear division between what the GP does and any cost he wants to run, compared to the actual investment that you made collectively.
Okay.
Now, to go a little bit further in that, we have the next sheet here, which will make it a little bit more detailed. On the right of the screen, you can see there that the investors, they implement capital into the investment fund, and then the GP can run the strategy, so to say, and the GP can ask management fees for that. It can also ask other fees, but we'll go into that later. Sometimes we see that the GP is split in a management company and a GP. Then the GP is more the one that executes the strategy, and the management company is there to help, so to say.
Right, so compared with the last slide, the management company and the GP are basically, in the previous slide, just the GP, so that could be split up.
Yeah, exactly that. Well, to set that up, you need a financial sponsor, which is usually the one that starts the fund. They need to pay for the setup costs, so to say. However, if you set up a fund which is closed-end, then usually those costs are added to the fund itself. So it depends on the structure, on if you need setup. If you need to have funds before you set up, or if you can incorporate that into setting up the fund.
And I think one thing that stands really out there is from the investment fund to the GP and to the management company, you see two types of different fees. So the success fees go to the management company and the management fees go to the GP. Can you talk a little bit more about how that works?
Yeah, well, it could be the same company, like we said before. So it could be that the management fee, success fee, any other fees, they all go to the GP, but you could also split that. And then the management company becomes more like a provider of certain services. And then you can add a success fee to that. You can add a fixed fee to that. Any way you feel fit, which works with the yield generation of the asset below, right? The portfolio asset. We can structure that in such a way that it makes sense, and that you can actually put incentivize in a right way that all parties involved do the right thing to create the highest yield, or to keep running for the investors, or any way that is the best for the structure that we set up. Now, next to that, you can also still, for example, at a real estate fund, if you would also be the realtor, you could still subtract fees, so the realty fee, from the asset below, and that's the box on the left, for example. Right. But also at venture fund, if you're doing management in a venture, or you're doing any other services to the venture, then you can of course keep that out of the structure and just only share with the venture fund, for example, the upside you are creating on on the capital appreciation of the shares of that.
So one of the benefits you could say is also basically that you have an extra income stream. So regularly, if you invest, for example, with the normal structure of a company, you just get returns. But in this case, because you have the fund, besides that, you also have a success fee that you can do, because you're basically managing the money and managing a strategy for which you get some extra returns. And you have the management fees for actually managing the fund and the capital itself. So you get more income streams. Is that one of the main reasons to start a fund, or would you say that's just one of the things that you can see as a benefit?
It is a big benefit, of course, for anybody that would run the fund, because you're also making, you could, well, it's a decision, right? It's not always baked in, but you could make an income stream just from holding the capital of the investors. So you could be like, okay, I'm creating an income stream for the GP because I'm keep managing the money. However, you could also only work on success fee, although you will have some cost of running the structure itself, like accountants' costs and stuff. So you need to cover that, and in order to cover those costs, usually there is that management fee, but you could also have like an administrative fee, which would be standard. So if we would go into the way you could make money from the fund, so to say, is that the first thing I want to point out is subscription fee.
Right.
Subscription fee is at the beginning. So when an investor deposits their investment, you could say like, I want 2% of the capital that you put in as a fee for you joining, and for me to make sure that lawyers are paid, that all the services are done. Right. However, there's also earning possibility there. Because then you can say like, okay, because I'm doing this, because I had the effort of meeting all these investors, I also want to earn there, or you just simply want to hire a team that would go out to investors and pitch the idea. So there's a moment there where you can earn some extra.
So there's a lot of different types of fees, and I can imagine somebody is going to set their fund up for the first time. They might be afraid to set up some of these fees because it might be overwhelming for somebody that wants to invest. Yeah. What's your experience with that? Because what I personally have seen is that in some cases it also brings some trust, because then the potential investor will know that you're committed to the fund and that operationally everything is going to be run, and that you're motivated to basically be focused on that fund on its own, for example. But how do you experience that with your project?
Well, 100%. It all comes down to what you're actually investing. Because if you take, for example, your investing venture, to take that example, you have not that many times that you actually see what it's worth, right? You start with it, then you know what needs to be invested to buy the share into the company, and then it can take 5 years before you have the exit in the company, that you can actually return the capital and return the yield to the investors. So then you want multiple times that you actually create an income stream for yourself. Right. And therefore the subscription fee is an interesting one. Usually it's about 2 months of return, but it very depends on what somebody thinks is relevant for their investors. There are also funds that don't charge anything on the initial investment, but that's just a choice you need to make, and that we're also providing insight in when we create a business model and a financial model when setting up these funds.
Very clear. And then the next one, we have the management fee.
Yes, so the difference between a management fee and a subscription fee is that the subscription fee is at the beginning and the management fee is an ongoing fee.
Right.
So the management fee is usually a yearly percentage of the total AUM, assets under management. However, it depends on how many times you actually calculate the assets. It's called the NAV, net asset value, that's calculated. And sometimes that's done every year, sometimes it's done every month, sometimes done every quarter. It depends.
Just a valuation, and it can be dependent on what kind of assets you're actually investing in.
Yes. And then we usually see that fee that would be yearly, you divide it over the amount of times that you, in that year, you would evaluate the assets under management.
Okay.
And that's and that 2.5%, for example, is over the total AUM. So if the AUM grows, even though your return is very good or not that good, you will still have that income. So it's a fixed income stream into the fund to make sure you can pay the cost of the setup, but also to of course get an income for the GP.
So as an example, we put the 2.5% there. Is there an average, or is it very loosely based on?
It's there are funds that charge way higher. There are funds that charge lower. This is a little bit the average, but it's all depends on what kind of yield are you expecting to make. Are you expecting to make a yield closer to, for example, bonds? Then this would be lower. If you expect a return because of, for example, forex trading, which goes up to maybe 25% or 35%, then this might be higher.
Can do more as well.
Although it's mostly combined with a success fee. And let's go to that in the next sheet.
Yes.
Because there are multiple ways you can set up this success fee. And especially first-time starters usually try to only work with success fee and have a standard fee for administration.
Okay.
But this way you can build trust with your investors to create a fund where you only charge success fee, because you have a equal playing field in which you will earn when the fund earns.
And that's basically to make sure that the owner of the new fund, because you might not have all these results lined up from the past, which experienced funds do have actually, and then you carry some of the risk because you only get your own reward once you're actually performing. That's the idea.
Exactly that. So the traditional way to share the yield would be just to say a percentage of it would be the GPs. For example, 25% of the returns will go to the GP. Then you calculate the return, and then you split it in a 75-25% way. Right. However, there's also the more complex way that you're going to say, and that's actually better in the incentive to the investor, where you would say like the first 15%, for example, would go to the investor, and then everything above it, it's for the GP, or everything above it, we would share 50-50. There are multiple ways you could set it up to really get the incentive clear, and then the investor is also like, okay, so I'm the first one that earns because I brought the capital. And then the GP only earns when we pass a certain threshold, and that can be very good for your raising campaign.
Yeah, so because you're basically going to say investor first, because you bring the capital, they bring basically in the most risk, so they get the first returns as well. And then if you reach, let's say 15%, that's called the hurdle rate. Yeah. After that point, the GP, so the manager of the fund, is also going to get their returns. And you said earlier that could be split up in, let's say, where they get a percentage of the returns or the whole returns. How do you see that mostly in the market?
Well, that really depends on the sort of fund it is, right? Because usually you see a success fee, especially in something where you need a lot of time and energy and involvement from the GP. But when the GP role is very passive, then usually there's no success fee added to the fund. So it really depends on what you're investing in, what kind of role the GP will have, or the management company in creating that yield.
Right. That's very interesting. So that's the success fee. Then on the next slide, we're going a little bit deeper on other things to take into account. So maybe you can explain a little bit more.
Yeah, well, this is regarding the setup of the fund, right? So initially, you need to start with the opportunities. Where you're going to invest in, what is it, what you want to do. We talked about that briefly before. And then you need to know the deal. You need to know if it's profitable, how profitable it is. You need to create some kind of business case. That's what we do usually with clients, is get that clear first. Well, then we're going to the funding. So we need already a pitch deck, like soft commitments of sponsors. So that's a parallel part of setting up a fund where you can actually start raising into the fund already with people that will give you a soft commitment instead of first setting up the full fund, right, and then only start raising. So we really like that way of setting up funds.
So first actual funding round is what you're going to start with, and then set up the funds when you already have some investors ready. Is basically what you would advise in most situations.
Yeah, it's a lean and mean way to start up the fund, and then you can actually talk to these investors like, okay, the cost of setting up a fund is going to be this and that. Are we going to put that into the fund, or is it something that the GP would carry himself? Right. And then with the legal setup, it will take a little bit of time. It largely depends on how quick we can get documents in, how quick we can get information in, and how quick we can work with the government on setting up the funds. Right. But usually it can be done very quick, and then you have a fund which you can actually start performing in.
Right, and with the funding, we might come further on this also later when we are talking to Derek, the lawyer. But there are some rules that you can already start fundraising basically before you actually structured your fund, right? Do you know a little bit more about how that works?
It really depends on the jurisdiction that you are. Okay. However, usually before setting up a fund, you're quite free in what you can do because it's the same as setting up a business. You just reach out to people that you want to start a business with or a fund with. In this case, a fund.
And then the last point is the fund management.
Yeah, the fund management is usually set up in such a way that you need three different, well, people, so to say, or three different teams. Right. The larger it becomes, right? But three different roles you need to fill. And that's going to be the yield seeker, right? The one that actually creates the yield for the investors. And you need somebody on the other side of the coin that's the capital raiser that's going to go to investors and raise the money to then use to create that yield. And in the middle, you need an administrator or a operations runner, so to say. And that's something that we also can do. So apart from only setting up funds, we also facilitate the administration for investment funds and everything that you need to comply with due to regulation.
Right. So we just briefly spoke about the team that you need in an investment firm. We're going to go a little bit deeper now and make a start about the operational aspects and the different steps along the way. Can you do a little bit of an introduction of what people can expect?
Right, so we just spoke about the team, and let's go deeper into how you would operate a fund from there on. So at the beginning, you will have a start date, and on that start date, you can actually onboard investors. You'll have that already with the fundraising part, so right. You know who's going to be in the fund, and you can do your first investment from that moment. That exact start moment will create a net asset value. Usually we start at €100 per share or $100 per share, depends on the denomination of the fund, and you go from there. Then there is the first moment, the first intermediate moment, where you will re-evaluate what the net asset value is. So the total pool of investments you did and the total pool of dry money you still have. And that will create a new share value. And let's say it went up with, let's say 2%, then also the share value goes from 100 to 102. How many times you will have this intermediate we talked about before. It can be monthly, it can be daily, it can be quarterly, it can be yearly. That all depends on the setup of the fund that you have concluded before you started.
And basically also, you can say it depends very much on which kind of asset you're investing in.
100%, because it all comes down to how many times you can actually also calculate the net asset value. For example, there's a difference between open-end fund and closed-end fund, where a open-end fund, it doesn't have an end, so it will continually do these net asset valuations. So for example, you'll invest in the stock market, but you don't want to have a large burden of compliance and calculation, so you do it monthly. But it can also be daily, for example. However, with a venture fund, for example, you don't have these valuations because the startup that you invest in is not registered on the stock exchange, so there's no
Doesn't
daily
have a
price.
valuation. Yeah.
So then it's mostly closed end, but also in real estate it's mostly closed end because there is a valuation once it gets sold or once there is a new round of investors that buy into the certain startup. Then you also have a valuation at that point. However, still not really. You're not sure on when that will happen, right? It can happen in a year, it can happen in 2 years, in 3 years. So therefore, you usually choose a closed-end fund.
So with an open-ended fund, what you often see, right, is that at the moment that there is a valuation, it's basically parallel with when investors can actually get into the fund and get out of the fund. Do you experience the same thing?
Yeah, it's the only way because you need a price in which you will add to the fund. You need a moment on which you're going to add new funds into the fund. And that will not affect the share price because you're adding new capital, and that will straight go into net asset value because when you add new value from an investor, it's on the asset side and on the liability side. So therefore, the share price isn't changed, and you can scale that to whatever size you want the fund to be.
And with the closed-ended fund, you have an end date where the fund actually ends and where the returns are going to be paid out to the investors, etc.
Let's say end. You're not sure if that's a date. It can be that you're quite certain on when it will end, and then there is a specific date. However, it can also be a period or a certain milestone you have to achieve in order to close the fund. It widely depends on. If we go to the first sheet again, it widely depends on where you're investing in and what your time horizon is that you first set with your investors.
So the example could be with a venture capital firm. Let's say they invest in a few startups and they're waiting until they go public to the stock market, and then you have a new valuation. That's the closing point, and that's where they.
And the going public is the milestone.
Right.
Or selling to private equity is the milestone. Yeah.
Very interesting. Thank you for the introduction on the structures and how you begin with setting up your fund and what kind of people you need in the team. This was the introduction from Rowan Rosemond. Next on will be Kelsey Bastiaans, and she will be speaking on the operational challenges in an investment fund. So we just briefly spoke with Rowan Rosemond about how you actually set up the fund and how the structure works, what kind of team you need. And now we're going to go a little bit deeper together with Kelsey Bastiaans on how we are actually setting up the operations, what kind of challenges there are. So can you do a quick introduction of what people can expect when you have their first fund in terms of operations?
Absolutely. I mean, Rowan has given us a nice crash course on alternative investment fund and how to make money with it. But then, of course, there's the question of how it works. As the operational aspects can be different for each fund. I mean, there's not just a common fund.
So let's say between a hedge fund and a venture capital firm.
Yeah, there are different possibilities. I will limit myself to the general points of operation. Starting with the operational structure. You have the legal structure. First, of course, the legal structure has to be worked out. Dirk will go into this in more detail later, so I won't tell too much about it. But in practice, it's usually an open-ended or a closed-ended fund, as Rowan already described, where you have a manager, which is known as the general partner, and a custodian, which is the legal owner. There are many other variations. These include an investment company, limited partnership, cooperative, LLC. Either way, it's really important to have a sound legal structure because that's essential, not to ensure only legal compliance, but also transparency, which is really important
for investors.
Yeah, absolutely. Yeah, more into detail, the management company, which is also known as the general partner. That is the entity which is responsible for the investment decisions and the day-to-day management.
So the strategy part.
Yeah, right. Absolutely. And the manager must comply with strict regulatory and reporting requirements, including the preparation, making the memorandum, prospectus, as you may call it, the investment strategy, risks, costs, everything actually. So yeah.
So what is the investment memorandum exactly? What does it do for the investor or for the fund?
It's a document. Dirk will go a little bit in more detail later. But the memorandum is a document which contains all the relevant information for the funds, for the GP, the custodian, the participants, the possible risks there are, the cost, if there's the lockup period. Actually, all the information there's to know has to be put in the memorandum.
So, for example, the boundaries of the strategy, right? So, what can you do or what can you not do with the money?
Absolutely.
Okay.
Yeah.
Clear.
Yeah.
And then I see two other things on the slide here: the deed of incorporation and potential other documents.
The deed of incorporation is the certificate of corporation. That's actually the start of the entities. Has to be done by the notary. Articles of association of the various companies that make the fund. So that's kind of the basis of the whole fund as itself. Then you have the key information document, which is a smart version of the memorandum and gives insight into the operation, risks, returns of the investment products.
And for other people watching, I think I might want to set up a fund. This sounds like a lot of work. This is also something we can support them with, right?
Absolutely.
So we just spoke about a lot of the operational challenges.
Yes.
Then on the next slide, we're going more onto the KYC and AML.
Yeah.
Can you walk us through how that works and what it does?
I can. KYC is Know Your Customer. AML is anti-money laundering. And both pathways must be completed for each investor. It's really important for the transparency and knowing that all the information is correct and there are no risks or at least as little risk as possible. KYC is Know Your Customer and that's important prior to the investment. So it's basically the need to collect all information, financial background, checking the sustainability for the investment for the investor.
This is a standard process that everybody needs to set up, or does the fund manager do it themselves? Do they hire a third party for this process? How does that do it mostly?
It can go either way. The fund manager can do it. They can hire another party. But if you want to know if the KYC process is fully provided in a good way, we just also always advise to do it yourself. Yeah, absolutely.
And then there's the AML process.
Yeah.
How is that different from the KYC process, and how does it look?
AML is more anti-money laundering and has more to do with the risks of money laundering, identifying risk profiles, monitoring transactions. If there's something which shouldn't be done, it should be flagged. Reporting suspicious activity. So KYC is just really knowing your customer, and the AML is just trying to make sure there can be any anti-money laundering
activities. Okay, so it sounds maybe for some people like, oh, I need to check all this data for my investors. It might be intimidating, but I think in the end it's also basically to protect them, because if another investor in your fund is not compliant to KYC AML, then you might be in trouble with your own capital. Is that the reason why they set it up, or?
Yeah, absolutely. I mean, compliance is really important, as well as transparency, and how more information you collect regarding the KYC and AML, the better you can contaminate possible risks. So yeah.
Right. And then we have a last part about supervisory reporting. So I see financial, compliance, audit. Stage is yours. How does it go?
In addition to the other requirements we already talked about, it is really important that the funds also complies with the guidelines, laws, regulations issued by the authorities.
Right.
So it can be financial reporting, perhaps an open door, but the fund must prepare annual financial reports, balance sheets, profit, loss, everything, including compliance reporting. How does the compliance work within the fund and the audits?
And this is towards the financial authority in that specific jurisdiction where the fund is set up?
Yeah, absolutely. Yeah, right. That can also vary per jurisdiction where you are with the fund. Yeah.
And that's and the audits. What do we see there?
Annual audits are conducted by an auditor to review the financial statements and ensure the integrity of the fund.
And this is different from the NAV, right? The net asset valuation.
Yeah, it is. Right. Yeah,
okay. Yeah. I think that's that's most of the introduction on operations.
Absolutely. I mean, the success of an alternative investment fund is part of a solid operational foundation, and by paying attention to the legal structure, constitutional documentation, KYC, AML, alternative investment funds can ensure transparency and yeah.
Great, thank you for the introduction.
Make it a success. Thank you.
Operations and some of the KYC, AML, and other compliance details people have to take into account.
Yeah.
Next up will be Dirk van Dam. He's going to speak to us about the legal considerations in different jurisdictions. So we're going right to him. So we just briefly spoke with Kelsey Bastiaans about the operational challenges when you start your own investment fund. Now here with me is Dirk van Dam. He's a lawyer, also the lawyer of fund structuring, and he's going to speak on the legal considerations and the framework of an investment fund. So thank you for joining us, Dirk. I'd be happy to learn a little bit more about what people can take into consideration when starting their own fund on the legal side of the business.
Yeah, great opportunity to talk about this. What I wanted to make clear immediately is that I will focus in my contribution in this webinar on the situation in Luxembourg and the Netherlands. We mainly, in this whole webinar, I must say, talk about the sort of medium investment funds, right. So-called alternative investment funds. To differ those from the smaller funds, which, well, basically resemble crowdfunding organizations. We're not talking about that.
Important for accessibility, but
very important and very useful in today's market. Absolutely, but this is not what we are focused on. We're also not focused on the larger funds, the huge, American government fueled funds. No, we are limiting ourselves to the so-called alternative investment funds. And we also do this because in the Dutch and Luxembourg legislation, there are several very interesting possibilities to start these funds in these two jurisdictions. Why? Well, all investment funds are embedded in European legislation. In particular, we're talking about the AIFM, that's the Alternative Investment Fund Managing Directive. And each EU member state is obliged to implement this directive in its national legislation. And Holland, the Netherlands and Luxembourg to alternative investment funds. Because, I'll explain this later, there is mainly a sort of a de minimis possibility incorporated in these two jurisdictions. You could call it a light regime. Well, in the Netherlands, this is worked out in the so-called Wet Financieel Toezicht, the WFT. In Luxembourg, we are talking about the Loi sur le secteur financier, the LSF. And these two laws actually introduce this so-called light regime. Well, and what does a light regime entail? A so-called medium fund. This implies that in an alternative investment fund in the Netherlands, your AUM, assets under management, may not exceed 100 million euros.
So that's a combination of all the capital that's raised from the investors.
That is so, right. Yes. Your total amount of investors should not exceed 150. And we at Fund Structuring work with the assumption that the minimum amount an investor should invest in a fund is 100,000 euros. So as to keep distance from the crowdfunding funds. And this is, well, keeping it on the safe side, so not to water down too much your investment potential. Yeah, so what are the advantages of a light regime? Well, mainly due to the de minimis legislation incorporated in the Dutch and Luxembourg national laws, you can abstain from a real registration with the national financial authorities. That saves a lot of money and a lot of time. It's enough to report to the authority that you have a fund,
Right.
period. Not necessary to register in the legal sense of the word. You don't need a custodian bank. This saves a lot of money and time as well. And you don't need a prospectus, an official prospectus, which in the larger funds you do need, and in the smaller funds you fall under the consumer legislation, which is also a lot of hassle.
So in this case, you have an option in between, which is quite accessible. The startup costs are a little less than, let's say, a pension fund, but it's still quite easy to set up.
Yes, it is, comparatively speaking. That really saves a lot of money, which gives you a head start in your fund because you don't have all these costs involved, which in the end always press your fund down from the start on.
Be a very high management fee, let's say.
That's it. You don't have that problem. Well, in Luxembourg, it's roughly the same. You also, in the de minimis legislation, you limit your AUM to 100 million. That's the same. Right. You can, in Luxembourg, you can work with more investors. It's limited to 500 investors in your fund, which is significantly more, obviously. And your minimal investment per investor is 125,000 euros.
Right. So in comparison, let's say if you only bring in 100K tickets in the Netherlands, after 150, you don't have your 100 million. In Luxembourg, you could raise more smaller size tickets, basically, but they have to be from 125K instead of the 100K.
Exactly. So it's possible to indeed splinter a bit more if you would like to do that. But still, it gives you, for most AIFs that we work with in Luxembourg and in the Netherlands, these numbers are more than enough. The advantages of this de minimis regime are huge in both Luxembourg and the Netherlands. Very attractive environments. The entities you need to start your fund. That is Kelsey Bastiaan.
Yeah, well, she gave a brief introduction.
Yeah, I know. So I won't go too deep into this, but you need a general partner, which is the sort of manager of the fund. And in Holland, that would be a BV, besloten vennootschap. In Luxembourg, one talks about a société, not a Société Générale, but an SCSP. Forgive me about the French at the moment, but it doesn't really matter. Anyway, it's comparable, limited partners. You also need a depository foundation, Stichting Fondation in Luxembourg. Which is the sort of the custodian of all the assets.
Since you don't have the custodian bank, as with a larger fund.
And that is basically it. You can expand a lot within these entities, obviously. We always advise, most of the time we advise to introduce an investment policy committee within the fund to advise the general partner on how the investment policy is executed. And so there are more things to provide your fund with, but these are the main legal requirements. Well, Kelsey Bastiaan's already touched on the necessary documentation. Yeah. I'll briefly go through that as well. Most important is the information memorandum, which contains the key elements of what's the fund for? Why is the fund introduced? What are its goals?
How it's aims? Invest, right? As well.
Exactly. Well, it's closely related to the key information document that contains at least an investment strategy and a risk profile for investors. Most investors will obviously ask for such a document, but the legislation also prescribes the drawing up of these things.
So do these risk profiles, are they predetermined by, let's say, the legislator?
Yes.
Or are these?
Yes. Well, obviously, the contents itself are related to the fund. The factors that you have to take into consideration are determined by law. Absolutely. And lastly, not unimportant, the EU sanction law policy document, especially in these days. With the whole Russia situation, quite important that you determine, okay, what can and mainly what can we not do in the fund when it comes to EU sanction policy and sanction laws, obviously.
So we discussed a little bit on the Netherlands, Luxembourg, but they all fall under the same European authority, basically. But there's some room to play with the rule set there, and that's also one of the things that we advise clients on that start up their first or second fund. Are these the two main points in Europe where people set it up, or are there other different options or interesting options to investors or fund managers?
Well, in Europe, as said, these are the main considerations to take into account. And mind you, setting up a fund, in the end, it's a technical matter.
Yeah.
So any question or problem or challenge that you face doing so, it's solvable. It's all legal stuff. I'm not degrading my own profession, obviously, but any technical matter that you encounter, we can solve it for you, no problem. Within mainly, obviously, these two jurisdictions. There may be overriding considerations to start a fund in another country, not being Luxembourg or Holland. True. But then you encounter several challenges not to be encountered in these two jurisdictions because the de minimis regulations are not there. Before I forget that, as soon as you have drawn up these documents and have determined that you are indeed eligible for the de minimis exemptions, well, then you give notice. When you have set up your fund, you can give notice to the financial authority. Notice, no registration. Remember that?
Notice. Right.
You can open a bank account. Of course, you need that. The depository foundation does that, stichting or fondation. And by experience, after a month or 3, you can have your fund up and running.
So once you get started, you decided where am I going to actually do my set up my fund. You're just going to look. You have to notify the financial authorities. Then you can actually already start talking to investors.
Absolutely, absolutely. Preparatory work to see if your fund is actually viable. Yeah, you can start with that already. Yeah.
Yeah, and then the opening the bank account, and it takes around 3 months.
Give or take. Could take longer. Could take a bit shorter. Depends. Yeah.
All right. Thank you so much.
No, not ready yet.
You still have something for us.
Absolutely. Because talking to investors and in general marketing your own fund, there are some limitations there. And it's called reverse solicitation. You really have to beware not to start going into the market and say, hey, I've got a fund and you can invest with my fund. No, that is not possible. There are ways around that, obviously. If you have your own website, the fund has its own website, there's own ways to promote itself, just not directly as GP interested party in the fund, go to investors and promote yourself. That is not what you should do.
So the main point there is that the potential investor has to come to you first.
Exactly.
About the fund.
There are several ways to deal with that, obviously, but we at Fund Structuring, we always promote transparency and compliance. Act in conformity with the law, or don't act at all, because if you don't do this correctly, you'll run into a host of problems that you do not want. And luckily, I cannot stress that enough, in Holland and Luxembourg, it's not necessary to walk outside the law. It's not necessary. The law gives you plenty of possibilities to, within these limitations that we just discussed, work in a profitable way. Well, we already briefly touched upon the other jurisdictions outside of the Netherlands and Luxembourg. It's a bit more difficult out there. It's a bit more costly, and you really have to delve into the local customs and legislation to make informed decision about those jurisdictions, and that obviously pertinent when you go outside of the European Union with your fund. I'm a Dutch lawyer. I know Dutch law. I know Luxembourg law to a certain degree. But when you go outside of the EU,
let's say Dubai, for example, is a
Dubai, Virgin Islands, what have you. Interesting, but then that's a whole different ballgame, and I can only advise anyone to inform him or herself very carefully before going there. Not only when it comes to legislation pertaining to a fund, but also all kinds of tax regulation that you run into then. But anyway, that goes a bit out of the scope of this conversation.
No, thank you so much for talking a little bit about the legal considerations and the setup. Next, we will have Jester Schilder, and he's going to talk to us more about how to actually communicate your fund, how to market it. We will also look at the reverse solicitation point we spoke about earlier and how you can actually present yourself instead of your fund, for example. And we're going to dive right into that. So we just spoke with Dirk van Dam about the legal considerations and setup of a fund. And that's all very interesting, but it's only the start, because once you have everything set up, we need to actually onboard investors. Otherwise, your investment as the fund manager is gone very quickly. So therefore, we have here Jester Schilder. He's responsible for the marketing and communications, also in fund structuring. And he's going to talk firstly about what Dirk mentioned earlier on this webinar, the reverse solicitation. So how do we look at that from a marketing sales perspective, which I have to say quite carefully.
Yeah, first of all, thanks for having me, Simon. We're going to indeed talk about the reverse solicitation, as well as how to position your alternative investment fund. And when it comes to reverse solicitation, you have to understand that it really comes down to protecting people from potentially investing their money in things that they should not invest it in. And therefore, when it comes down to reverse solicitation, people have to be a sophisticated investor in order to present your investment opportunity. And it's mostly about just not blatantly soliciting and not blatantly promoting and advertising your alternative investment offer. Now, that doesn't mean that you cannot build your network and make it go from there. So my advice in general is to just focus more on yourself, focus more on your personal brand, build your network, but just don't promote it. Build your network, and when you're building a relationship with someone, at any point in the future, they want to know what you're doing, they want to know what you're about, and that is a moment where you can tell them about it, and then you reach a natural solicited or reverse solicitation.
So that could be, let's say, if I'm very well versed in investing in startups, but I'm going to a conference, I meet somebody, I can talk about what I think about how startups could grow potentially to the biggest returns, which would be beneficial for me, but not per se talk about the fund yet. They have to ask themselves in that case, like, so what do you actually do? And then reverse solicitation barrier is broken.
Yeah, I love your example, because you should not go to an event and have your business cards in your pocket and give them to everyone and tell them about your investment offer. But of course, you can have a conversation. You can tell people that you are in the investment industry, and you will naturally reach the point where reverse solicitation happens. You just should not be the one who's actively promoting it.
Right. So how do you select what kind of investors you have? How do you create a profile, let's say, around them?
Yeah, great, fantastic question. I believe that it is very important to build your alternative investment fund around your ideal investor profile. There are different types of investment funds. You have short local periods, you have long local periods, you have high risk, you have low risk, and not every investor has the same appetite. So it's going to be very important to make sure that you have an ideal investor so that you can build it all around it, as well as realize that as a fund manager, you're literally managing funds of other people. So one of the main jobs that you're actually having is managing the money of other people. So making sure that that you have this very clear is just important. There are a few things that you really need to take in consideration when you're going to profile your investors. If you're going to, let's say, have a crypto hedge fund that is going to be high risk, then people would like to also take out their money more quickly. So they want to be able to take out their money within 3 months or within 12 months, which might be very different than, for example, doing like a low risk real estate, and they might be willing to have it in the fund for 5 years completely locked up. So you have to really pick your profile and also see what their considerations are and what is something that they find important. To give the example of, let's say, real estate, they might care maybe more about ESG than other types of investors. So that's how you kind of profile everything together. You look at risk appetite, how long it's going to be locked up, the type of industry they are in, and take it from there.
So with a lockup, you basically mean you invest your funds, but you cannot per se get them out immediately. So it's about the liquidity period.
Yes, exactly.
Right. So then you have your investment profile or your investor profile, what kind of person actually fits to my type of fund. But how do you then differentiate your fund in a way that it actually stands out to the investor that is asking about more information?
Yeah, that's a great question as well, especially since the alternative investment world, it is a competitive market. So before you go to the market, you really need to strategize and make sure that you're actually going to put a fund in the market that is going to be different, that you're going to differentiate yourself. And there are several ways to differentiate yourself. The first is just you're going to be your performance. That's what you're going to be judged upon. So if, let's say in the future, you're thinking about starting a fund, make sure that the asset class that you're in, that you're just going to be really, really good at it. So, or you're going to be a fantastic trader, you're going to be really good at real estate. Just really know your stuff so that you can get great results. Make sure that you have a solid team. If it's just going to be you in your fund, then that might be less interesting for people, as when you maybe have 5 other board members that are also having a high profile. So building the right team around you is a way that you can differentiate yourself. You can build a unique proposition, for example, within your proposition. So let's say you're a trader, you can come up with a different trading strategy so that you may be dealing with investors who are already trading, but they want to add that additional trading strategy to their overall portfolio. And I would say, lastly, you can look at elements such as ESG and also bring in those components in your overall fund operations.
So can you go a little bit deeper on what you mean with the ESG aspect? It's very new in the market, but you hear it more and more.
Yeah, it's in general quite new in the business world in general, and especially when it comes to corporates, they really have to still find their way to go about it. So what I always advise, especially to investment funds, is what is a way that we can do good to the world, and what is a way that we can give back, and what is actually something that I'm personally passionate about. When you know that, for example, let's say you want to invest back into the town that your fund is set up, you can do something within there. So just find your passion and find a way to give back. Maybe don't focus too much into the specific ESG, because eventually it will also come down to the investors and what they personally like. But the easiest is to do what you like, and then you will automatically attract similar kind of people into your fund.
From your own network perhaps as well.
Yeah, exactly.
So in the beginning you said the track record is one point that's very interesting, or a very important point for investors to take into consideration before they invest, so they know what the returns are going to be. But we also work with a lot of people that set up a fund for the first time. So what would you advise them when they do perhaps not yet have a track record, because it is actually the first time that they raise money for their fund and do it in the setup of a fund? What would you say are key aspects they should take into consideration when communicating to potential investors?
Yeah, I would say before even maybe going there, already before setting up your fund, try to build your track record. So you can maybe set up syndications, or you can do smaller projects. So this way you can build it up and you can actually show something. So for example, if you're going to set up a venture capital fund, before you can show what you actually have been doing as an angel investor, so you can take those with you. But besides that, when you actually set up the fund and you have a limited track record, it all comes down to transparency and showing what you have done before, because it comes down to trust. So maybe when you have your first fund, the period that you're going to be fundraising, take a little bit more time out of it. Understand that that's going to take longer, and that maybe instead of 1 or 2 meetings, you might need a few more meetings to really explain your strategy, because they're not going to yet just take that risk, but they will also risk in your strategy. But that also should not be a discouragement, because when you actually build that relationship, they will be more involved with you. They might also share their thoughts on your strategy, and you can really do it all together.
So what you said is quite interesting. Depending on the fund or on the network of the person, the time of raising funds might be very different. Right?
Exactly,
So
yeah,
let's say some people, they will start a fund, but they don't have connections, they don't have the network yet for potential investors, they have to set it up. Is there any period you would say that you have to take into consideration when you want to start your fund, but perhaps you do not have the network yet?
Yeah, usually when people have a network, it can still take about 3 months, because it's not going to be all happening immediately. So you have to definitely take that into account. If you don't have a network, it almost, especially in fundraising, comes down to building your network. when you're fundraising, because especially because of reverse solicitation,
Right.
you can only solicitate to people who are actually in your network, who you already know and who know what you're doing. So you need to build your network, and you cannot build a network in 3 months. So it's important to take in account like a good year where you actually are going to build those relationships so that they can become part of your fund.
Right. Very, very interesting. And I think this differentiation is also crucial because of the reverse solicitation, the only people that are going to get to see your documentation and your information are the people that come to you. So make sure that's set up correctly as well. So then we go to the raising capital. One of the things you have said repeatedly is leverage your network. What are other things you can do to get money into your fund?
Yeah, so besides making sure that you have your network ready, the easiest thing that you actually can do is find someone who is specialized in fundraising. Someone who might have a big network, maybe someone who comes from another industry where they have been dealing with investors or high net worth individuals.
Right.
And then give that person a actual share in your fund, because this way they're going to be part of your team. And fundraising is one of the hardest parts of getting your fund set up. So it's going to be completely worth it to bring in someone who is an expert at that.
And is that any fundraiser, or would you say that per asset class, for example, there's a type of fundraiser that has a specific niche for that, or could you just bring anybody on board?
That's a very good question. You cannot bring anyone on board because it really depends on the type of risk profiles that you're going to set up. It's going to be investors who have like a lower risk appetite, a higher one. So if you have someone who's specialized in raising money for a low risk real estate, it's going to be extremely hard for that fundraiser to find people for like a high risk crypto hedge fund or something in that direction. So ideally find someone who fits within that criteria already.
Yeah, so it's quite crucial actually then to qualify the potential fundraising partner, that they have the network that could actually fill up your fund, so you don't waste too many efforts on an investment fundraiser that might not fit your fund.
Yeah, I love the word that you said, qualification. For anyone who's going to be part of your fund, really make sure that you qualify them, and that you know that they have the experience and the network and the resources to actually make it happen. Setting up a fund is not easy. You need someone who actually has the experience and the accolades to do it.
And are these the only ways to raise money? So we have the fundraiser, we have the network. Are there other things you can do to bring on board capital?
Definitely. I would say there are two more options that you have. The first one is capital introductions. And this way you actually entice people to introduce you to potential investors. So people who might be already working with high net worth individuals. An example of that could be a wealth manager. You can approach local wealth managers and you can build a relationship with them, and you can make an agreement that they get a compensation if they're going to introduce you to interesting investors. So that are capital introductions. And then what you also can do is hire a company that is specialized in fundraising. Such a company is called a placement agent. And they are really good at it. They already have a network in place. They're also a little bit more expensive. So what you often see is people start their first fund and they do it in their own network. And when things are going well and they have the first money raised, then they hire a placement agency.
Right, and I think also what's quite interesting is that with all these situations where you have a fundraiser, you have capital introduction or a placement agent, you basically tap into an existing network. So when you start networking for yourself, would you say that's also a strategy you should apply, where you look at existing communities where you're going to network that might already invest in your space?
Yeah, that's a good one as well. There are a lot of events. Even nowadays, there are Facebook groups that you actually can find. If you're in real estate, there are Facebook groups out there where there are already thousands of investors in there. Then the same, don't go into the group and immediately start like spamming and promoting it, but actually take your time, invest into that specific community, and always when you invest and when you give, you will get back in return.
Right. Thank you so much for the introduction. I think you spoke a little bit about what kind of investors do we actually want to bring on board and fits the strategy of our fund and the risk profile, and how do we separate our fund from potential competitors. That was also the last part of this webinar where we spoke about the communication framework. Jester, thank you so much for giving some insights there. So for all the viewers online and at home, thank you for your attention and watching to our presentation about everything you need to know to set up your own investment fund. If you have any questions, feel free to reach out to anybody in the team. We all have our own specialty, so our contact details will all be up in the screen right now. For legal, you can talk to Dirk. For operations, you can talk to Kelsey. Do you want to know more about the communication challenges? We have Jester. And do you want to know everything about the structure of a fund? Feel free to reach out to Rowan, and he's going to help you with that. Do you want to set up a consultation call? We do free consultation calls for people that are interested in setting up a fund. Feel invited to reach out to me. This is without any things you have to do. So just share your details, call us, send us an email, and we'll be happy to assist you. Thank you so much for your time. This was fundstructuring.com.